Right, hello. Straight into it with this one. We're looking at Criteo. Came up on my screener. Obviously, you can see why. It's had a hell of a downturn so far this year. And what are we looking at there? Peak to trough, 58% downturn. So certainly shows up in my screener when stuff's lost that much. Here. This one here. Right underneath. Maintain the buy. All right, interesting. This is some relatively new stuff because I looked at this probably a week or so ago. I think when we put the last video up, I said we were going to mention it. Haven't got around to doing the video yet, so we're doing it now. So first off, Criteo. Let's drag my notes up here. Look. It's advertiser. One thing I have noticed as well, mine, before we get into that, is this insider buy, these two here, they're not significant, 150,000 between the two of them. It's not earth shaking, but when you look at the history of it, all sales, these two have only recently happened. They hadn't happened when I'd valued the stock. So this is actually quite interesting, that this has happened since I've last looked at it. I'm not sure it's going to change my mind on Criteo, but still interesting to see that. So it is a global advertiser, headquartered in Paris, France, and listed on the NASDAQ. So what they do is, Criteo is best known for retargeting ads, so those personalized ads that show you products that you've already looked at online. So say you looked at something, and then all of a sudden you go on Facebook or Instagram, and all of a sudden that thing that you've looked at is advertised to you there. That is what Criteo do. They earn their revenue primarily on a cost per click basis. So every time someone would click on an ad that they've shown, there you go. So you mean an advertisers pay when users click on their views or their ads. So one thing about Criteo is that it's going to be in a very tough industry. You're going up against Google ads, Amazon ads, TTD. I can't remember what TTD was, but I did look at it. I said this was a week or so ago that I did look at it. But yeah, so you're up against some behemoth companies there, like Google ads, Amazon ads, Facebook do ads, don't they? So it's a crowded business, crowded industry. So their breakdown of their revenues, performance media, retail media, so media trading, retargeting type business. So that's, like I said, that's what they do. You see an ad, they try to, or you look at a product and then they try to show you it again later on somewhere else. So yeah, getting into the revenues, let's bring up the spreadsheet. Which one have I got on here? Got a few open. This one here, CRTO. So they're reasonably consistent the last few years. 1.9 billion, 1.9 billion, 1.9 billion, 2.1. They've had, some slightly better years, but they're very consistent. One other thing as well that I've noticed is that the gross margin is increased quite nicely, whereas SG&A margin has stayed reasonably consistent. It's actually dropped a little bit year on year. What else did I write about this? Criteo shows 1.67 billion in performance media segment in the same period. Retail media segment was around 266 million. So the performance media section is by far their biggest revenue earner. The retail media section has been growing very strongly, 20 to 25% year over year, even though that is currently the smallest portion of their business. Our performance media is relatively flat or declining. In their Q4 2024 results, they disclosed retail media revenue for Q4 was 91.8 million, up 20% year over year. So it's definitely becoming a very important part of their revenues. So 892 million in Americas, in Europe 676 million. So and Asia Pacific 360 odd million. So they are global, definitely global, and the US and Europe are by far their biggest. It's not too much size difference between the US and Europe, really. But future risks wise, they're in the middle of changing what kind of company it is. Historically, it's made the most money from its retargeting ads, which we spoke about. But with like privacy changes, especially in the EU, and decline third-party cookies, that business is shrinking. So now they're trying to go to the commerce and retail media platform, more like Amazon ads, and obviously transitions, they take time. So that is a risk to the future. If their AI algorithms as well perform poorly compared to their competitors, then customers would just switch, because why would you stay somewhere when there's a better alternative to get your adverts seen more elsewhere? So to maintain a competitive edge, the R&D spending is considerably, it has to be a large portion to keep, especially when you're going up against Google, like Google AI and all that sort of thing. They're, that's tough to compete with. So AI tech is also changing fast and could make Criteo less unique. And it also relies on tracking behavior and personalized ads. So obviously regulators, depending on what regulators feel about that, if regulators toughen, crack down on what you can track and all that, then that's going to be, very, very detrimental to Criteo's business model. Advertising is also cyclical. So when the economy slows, companies cut their marketing budgets. We've seen that with WPP. They were struggling because people were just, one of the first things they do is we ain't got enough money on advertising. So at the moment, we're not going to do it, It's announced plans to move its legal headquarters from France to Luxembourg, a move aimed at flexibility for potential US acquisitions. The only thing I don't like as well is that there's low insider ownership. Management doesn't own a big stake. So I personally see that as a, it's not a sign of weakness, but it's not something I like. And share buybacks to the main capital return strategy, but if business growth stalls, then that might offset the valuation pressure. So they have bought back, 64 million down to 53 million. It's not like they're not doing it. They are buying back shares. So that is good. What else have we got? So what's been done to combat the decline? So they're trying to switch the part of their business, really. They've done a major integration deal with Google, which is obviously weird because it's one of their competitors, but then Google's not going to turn around business, are they? I guess. So that brands can buy Criteo's network of 200 plus retailers via Google's platform, giving Criteo access to additional demand. So that is a good, thing. They've partnered up with another major global ad agency. They're streamlining their products. They're trying to streamline R&D by moving more into retail media, which is obviously, we said that it's higher growth already. By to shopping and commerce, they're aiming to offset the headwinds of the performance media. So they are doing things, but they're doing things that will take time to come to fruition. Reorganizing leadership as well. Time will tell whether or not that pays off. These initiatives are positive, but execution remains. It's one thing to announce integrations and partnerships, another to translate them into meaningful revenue and margin growth. So we'll see. Balance sheet. So I thought the balance sheet actually looked quite good. If we just, we'll pull it up here actually. CC financial statement. Where are we? Balance sheet. Here's the top. I'm not even looking. So 205 million in cash. Just under 700 million in receivables. That's 800 million of your billion. That's not. It's reasonable. 800 million in liabilities. Payables quite high. Operating leases as well. I don't tend to count them. I'm with Michael Burry and Keith Gill and all that on. If you've got an operating lease, and you can. There are ways to get out of it, or you can just release the property yourself. Don't have a lot of tangible assets. This is something that I don't like in businesses, though. There's a huge difference between book value and tangible book value, but tangible book value is positive, so that is something. But book value it has grown. $7 in the last 6 years, so that's something. Tangible book value, on the other hand, has pretty flat. Current ratio is quite good. They got enough money to pay for their current liabilities, which we've seen. This interest coverage, I think, is wrong. I had to do some adjustments on the free cash flow in the data. The data is not correct, but I might have written that in my notes, so we'll go through that. So 700 million of 2 billion total assets is goodwill and intangibles. Don't like that. So due to the low due to that, we've got tangible book value considerably lower than book value. Current ratio is the highest been for 5 years, and return on capital from EBIT and free cash flow is currently 60+%, but free cash flow seems to have more than doubled this year, so it's something historically off. Historically, both ROCs have been around 20 to mid 20, but this is because they're shifting to better. Is this because they're shifting to a better margin? So I haven't really looked into that because it's not a business that I think is cheap enough currently, but I've noted this down, so if I do come back to it, then I can look into that. I've got no worries about the debt. Interest coverage has always been fantastic, and debt is way below the cash levels. If we bring up here, what have we got? Where's total debt? So they basically haven't really got any, have they? Anything down here? Leases, employee benefit, share-based compensation. So they don't really have any. In my spreadsheet, it says total debt down here, 109 million. So it's nothing really. When you've got a 255 million cash position, I'm not worried about the debt of this company. It's fine. The interest coverage has always been fantastic, like I said. So debt we've just shown is 50% lower than cash. So good, good. That's what we want to see in a balance sheet, really. The only thing is the tangible assets for me is not great. I'd be more worried about that if there was debt, but as there is no real debt, I'm not that worried about it. So they bought back 10 million shares, which we said in the last 6 years. The revenues, which we've already shown, have been very consistent around the 2 billion mark. Gross margin steadily increased. SG&A margin still stayed reasonable, so we spoke about that already. R&D margins have doubled since 2022, but this is what we were saying about having to, down here 6-7% up to like almost 14%. You're now trying to compete with big advertisers that have got, the sway of AI behind them, and you're going to have to spend on it, or you're not going to compete. And that's where they're at, really. And I don't know if that's something that's going to change coming forward. Probably not. But the operating margin and net income margin stayed very reasonable, around about 4%. So we are in normalized earnings territory, I guess. They had a couple of down years here, but they are back to where they were before. So like I said, we are in normalized earnings territory, I guess, when you look at that from that point of view. So still have an active share repurchase program and no time horizon for it. There's a remaining authorization of 200 million, but no commitment to use it. So that'd be around another 9 million in shares, taking the count down to 44 million, 17% difference. So that could take book value to $25, $26 if they use it. And that's a big if, because there is no, no time to horizon to use it, and there's no commitment to use it. So it would appear that their Q4 is always their biggest quarter. On their cash flow statement now, so we're on to this one here. This is a quarterly one, so Q4 earnings significantly higher than every other quarter. So obviously we're coming up to that. That will be the next one to see what's gonna happen with that. We haven't got the data on that yet. Oh, there we go. So I've checked Wisesheet's data against figures last year, and it is accurate. So maybe that cash flow is accurate. There's been significant year-on-year cash flow growth, so free cash flow could be accurate. There's no apparent one-off earnings in the latest Q3 results for the last 9 months, so we can see that here. Statements of cash flows. That's the wrong one, isn't it? There we go. Yeah, so nothing really one-off, compensation expense quite high. amortization. So there's no one-off instance really that I can see. I don't know what I'm doing. Let's point that out. I don't know what I'm doing. I am somebody vlogging my journey to try and become a successful investor. I don't manage any money other than my own. I've got no qualifications in it or anything like that. So you are watching a very raw person learning as they go and just sharing their experience, just in case anybody in the future wants to, to go down a route, and if I can become successful as a blueprint for other people, But yeah, no real one-off in the last 6 months. This is no real one-offs. So I got the wrong one up, have I? Have a look. There we go. There's no only just come out. That's why I look. So no interactive data on it yet. Significant swing in tax benefit of almost 40 million, positively affecting operating cash flow. Receivables have been better collected, but payables have grown larger by 60 million. So we can see that on the balance sheet. Payables ain't up. This might actually be the latest Q3 results. So, like I said, sometimes the data is wrong. Annoyingly, for this video, I haven't looked at it. The bloody data is wrong, unfortunately, or inaccurate. Anyway, moving on. So, day sales outstanding has significantly increased, collecting receivables 30% faster. So obviously that's positive for cash flow. But day sales from payables has also got better by 14 days. So that sounds positive, but it more than doubled what it was 5 years ago. So that is in my working capital thing here. So this is wrong at the moment because that data is not in it. But if you look here, look, 80, then it doubled to 160, and now we're 232. That's very positive for operating cash flow, and it can be a sign of, I mean, I wouldn't, I'm not saying they are manipulating it, but if you're slowing down your payables and keeping your cash on the books longer, it looks better. If you're not paying them as fast, it looks better, and it's not something I like to see, especially when you've gone from 73 days even down up to 232. It's not ideal. Not ideal at all, really. Interest coverage has always been very good, though, due to low debts. Like I said, no worries about finances. Peer performance here. I did it against TTD because Amazon, unless you're going to go into Amazon's breakdown of their earnings and Google's breakdown of their earnings, which I wasn't willing to do for something that I didn't see too much upside in currently. I mean, I could be wrong when you look at where the price has been historically, but for me, I just don't want to pay that much for that sort of thing, But EV to sales is very low. It's a book, price of tangible book. So I don't know. When you compare it to TTD, though, look at the difference in gross margin. They're supposedly getting 80%, operating margins of 13%, net income margin of 12, close to 12%. That's a much better business than what Criteo currently is. But then their simple free cash flow margin is currently terrible, and their EBIT margin is supposedly terrible. So swings and roundabouts on that one. So going forward to forecasting, revenues are apparently forecast to grow slightly, but I'm still going to use a smaller figure because I like to be conservative in my analysis. I agree with Joel Greenblatts. If you put garbage in, you're going to get garbage out. And my opinion is that if I put conservative numbers in, then it still seems cheap, then I'm probably onto something. If I just take it at their word that something's going to happen and then it doesn't, that's when you get hammered. That's when you see everyone, oh no, they didn't meet expectations, and then the stocks plummet. And so I want to know that it looks cheap on as conservative valuations as I can do. So I chose 100. I chose 1.85 billion, even though historically they've done around 2 billion. And the historic free cash flow margin has always been around about 4%, which we've shown earlier. So I'm happy to use in my forecast at least 80% of that because it is reasonably consistent. So that would give 128 a share, so a multiple of 16, just under 17x. Now, historically, the average has been around about 13. You can see here it's been lower. I think I asked ChatGPT what the industry average was, and I believe it's around about 13. So 17x currently for me is just not cheap enough. All forecasting figures that I use, so PBRI, which is here. So look, I forecast it into the future, and then at a certain date, I sell the business for a multiple. So after 5 years, I sell it for a multiple of 10, these cash flows, and you add it to it. This is from his Dando investor. And up here is just a simple discounted cash flow, and I would add that to tangible book value. But they're all coming out around 12 to, $14, $13. JG EBIT multiples like 13.6. So the EBIT side of it, I suppose, is cheap, but the market cap side of it is still higher than what it is average. This is on my future forecast, right? That's not what it is. No, that's not me saying what it is now, but on my forecasting compared to what it was, I don't believe that there's enough upside in this stock for me. Buybacks could obviously increase that value materially to 15, 16, but to me it's still overvalued. ChatGPT believes 12 to 15 is likely the average multiple for the advertising business, and TTD, which is the comp, is way above that. At current forecast, 17.6 is overvalued compared to the average. What ChatGPT is saying is average for the advertising industry. So for me, currently, it is a pass. But I've got it all here. I have put in the top lot. I believe it's probably worth 13 to 14. Should it get cheaper? I mean, there's going to be a lot of people that say I'm a moron and that's wrong, but I'd rather be very conservative and not lose money than be overly optimistic and lose money, But the balance sheet's good. It sounds like there could be a turnaround on the way, but time will tell. And when you look at it historically, where it's been, I suppose, but to me, technically as well, right? Technically here, not that I'm a technical analyst, but if you look at this, it sort of looks like it could come back down. You're testing the underside of this area here, and like your next stop could be 17, even down to 11. This is technically, right? I'm a fundamentals investor, but I started my investing journey with technical analysis, and I don't know, like this seems lofty for me. $46. I mean, it'd be lovely, wouldn't it, to have a double, but when you're looking at this technically, breakthrough, retest it, could come lower, generally what happens, that you can see that here, breakthrough, retest the area, goes higher, breaks down through, retest the area, goes lower. So we are currently in a retest area on this technically. I said I'm fundamentals through and through, but I do look at the technical side of it as well, because I feel like that's a psychological, shows the psychology of the market, and obviously the price is doing this, so this is what the masses must think. You know what I'm saying? Probably not. But this area still historically has had a lot of prevalence, right the way back to 2017, 2018, 2019. Stopped here at 2020, came down 2022, 2023. We're here again in 2025. So this area here is actually quite a prominent area. And if this happens and it retests, it could go lower from a technical standpoint there. Not that I invest on technicals, I absolutely do not, but it is sort of lining up with my idea that it is overvalued. And if that plays out, then, I guess there's something to the forecasting with technical analysis. But yeah, there we go. Criteo, gonna leave that one there. Thank you very much for watching. I tried to keep this one shorter. I don't know if I've actually succeeded. We will see when I put it all together and edit it all together, but that is what I've looked at. That's what I found. I've got a couple more others actually lined up. One I quite like next, actually. So maybe I will try and record that video now while nobody's in the house, but I've got a funny feeling I'll be joined again soon, so we'll see. I'll edit this one, get this one up, and I will see you on the next one. Thank you very much.